Many people hear the phrase global diversification and assume complexity, specialist knowledge, sophisticated strategies. But in reality, global diversification can be surprisingly simple. It is not about speculation. It is about structure, from concept to model. In the previous episodes, we examined the environment surrounding capital, geography, currency, jurisdiction, tax structures, access risk. Now we move from concept to practical model. Something accessible, something implementable, structural layering. Global diversification does not require predicting markets. It requires structural layering. A simple model can be built around three components: global equity exposure, real asset exposure, multi-currency liquidity. Global equity exposure. The first component is corporate exposure across multiple economies. This may include broad international index funds, global market exchange traded funds, investment funds whose revenues are diversified across regions. This spreads exposure across continents, not one economy, not one regulatory environment. Real asset exposure. The second component introduces diversification beyond equities. This may include international real estate investment funds, infrastructure funds operating across regions, commodity-linked assets. Real assets often respond differently to economic cycles. This provides structural balance. Multi-currency liquidity. The third component addresses currency concentration. This involves holding a portion of liquidity in major reserve currencies through internationally accessible accounts or investment funds denominated in different currencies. This reduces dependency on a single monetary system. Now pause for a moment. If your entire investment portfolio tracks one domestic index, is that truly globally diversified? Not necessarily, because revenue source matters, domicile matters, currency exposure matters. A simple illustration. Imagine total investable capital of £500,000. A simple diversified model might look like this: 60% global equity exposure, 25% real asset exposure across regions, 15% multi-currency liquidity or short-term instruments. This is illustrative, not prescriptive. The principle is layered exposure, corporate exposure across continents, asset exposure beyond equities, liquidity exposure across currencies. Now reflect quietly. Does your current allocation reflect global revenue streams or domestic dependency? Blended models reduce concentration, without complexity, without speculation. Now consider something subtle. Diversification is not about eliminating domestic exposure. Domestic assets often provide familiarity and sometimes structural advantages. The objective is balance. Balance reduces structural fragility. In the final episode of Season 6, we consolidate global positioning into long-term optionality. Not fear, not relocation, but strategic freedom.